This is brought to you by John Daniel Partners LLP.
At this juncture, I'd like to welcome you all. Thank you so much for joining our webinar. As I mentioned at the start, we normally have these monthly webinars and they are normally free of charge. And our aim is to empower SMEs and keep them informed on the various tax changes and what they need to watch out as they run their businesses. And our topic for today is Unpacking the 2025 Finance Bill. Our speaker for the day is CPA Daniel Chege. He is the managing partner at John Daniel Partners LLP with over 20 years experience in the finance industry and also areas to do with taxation. Yes, please, when the webinar and the discussion is ongoing, please keep your mics muted. And then if you have any question that arises during the presentation, feel free to leave it or drop it at the chat section area, and our professionals will address the questions as they come in. Thank you so much. Welcome, Mr. Maina.
Yes, good morning again, everyone, and welcome to our webinar today. So for today, we are looking at the Finance Bill 2025, and we'll just do a quick introduction and then we go deeper into the specifics of what the bill says and try to bring out the implications. What does it mean? How will it affect you? How will it affect those who are targeted by that specific change? And then, of course, we'll try to address any questions that you may be having, whether you put them in the chat or even maybe towards the end of the webinar. We'll allow participants to unmute and probably just give their comments or questions. So I will start with a quick overview. And here we're just trying to I mean, where does it fit in? Of late, of course, you must have realized that the finance bill has attracted a lot of attention, not just this year's bill. Last year's bill, you remember the Gen Z protests that came up opposing the Finance Bill 2024. Why do we have these things annually, and why does the government put in these changes, tax changes? Now, as you may be aware, a finance bill is just a bill like any other statutory bill, a bill that has been presented to Parliament. And the aim is basically to put it through the legislative process so that it is discussed, is debated, and finally agreed on, and then once it receives a presidential assent, it becomes an act, meaning it's a piece of legislation, is a piece of the law that must be implemented. So the aim of having a finance bill is basically to change laws. And most of the laws that are targeted are those that relate to taxes. So that's why we'll be going through, for example, the Income Tax Act changes and VAT changes. And those are the changes that touch on the tax laws. And the aim is basically to direct a government policy. The government has decided it wants to prioritize certain areas, and it will make the changes or propose changes. And those changes, if the government has its way, then we can assume that government will achieve its objectives based on those laws. Again, remember that tax changes are mainly aimed at revenue collection. The government wants to collect revenue, taxes that will ultimately comprise the main budget of the country. So the government would want to maximize tax collection, collect as much as possible. And of course, the government is made up of politicians. Politicians make their promises when they are getting into office. And when they are making those promises, of course, the downside or what they don't tell you is that we'll need a lot of money to fulfill those promises. And so once the government, the elected people are in office, now they have the mandate to raise revenue and be able to carry out whatever they want to achieve or be able to fulfill their promises. They would want, of course, to fulfill the promises. Whether they do or not, now that would be something for discussion, maybe in a different forum. So the finance bill will come every year, and it comes around this time. Why this time is because we are preparing to enter into another financial year for the government. The government's financial year starts on the 1st of July every year and ends on the 30th of July. 30th of June, the following calendar year. So the financial year for the government, because it's about to start, so the government will have to think in the next financial period, what are we going to do? How much are we going to, do we require to raise? How much do we need to spend on which areas? So the fiscal policies, the changes in taxes are related to that. Remember, most of the expenditure for the government will be fixed in that it's ongoing. For example, salaries. If we say, for example, I think in Kenya, the largest group of employees are the teachers. The government has, very many teachers, and it is paying teachers. It is having employees, public servants in office. So those expenditure, they are fixed more or less. And of course, there will even be demands for salary increases here and there, additional teachers here and there. So the government is able to predict in terms of expenditure. This is about the much that we will require. And then how much are we going to raise? We are going to raise this. So because we need more to spend more on salaries, or we need to spend more on building roads or whatever, then where do we get the money from? We get money by taxing people. If you want more revenue, probably you enhance tax administration so that you tighten any loopholes that are happening, or the loopholes that are affecting the government's ability to raise taxes. And then, of course, there will be significant expenditure, so the government may also be forced to borrow. If you remember, a few weeks back, the president had a trip in China, and the government would want to have a very, huge project, a significant, which take a significant part of government expenditure. For example, building a road. If you want to build a road from Nairobi to Nakuru, Mau Summit, costing close to 200 billion. And that's a project that's coming. It's not a day-to-day. It's not one of those common expenditure items like salaries. So this is one item that you'll have to provide for. How do you get money for such a huge expenditure? So you may have to borrow. And remember also some of these relate to foreign exchange, stability, the exchange rate of the country. So if you are borrowing locally or you are borrowing internationally, there are economic implications. But for today, let's agree that the finance bill is aiming to raise taxes. And of course, also let's accept that we are dealing with very much aware public that is very much aware or informed. Some years back, there was no social media. In our days when you are growing up, there was only Voice of Kenya or KBC as the only source of news where we would receive news through the radio or through the television. And the government owned Voice of Kenya or owned the KBC even today. And so the government would tell the public what it intends to tell. Today is completely different. It's completely different. People are very much informed. So because of that level of information, the government is put under pressure. The government has to come up with very innovative ways of fundraising, raising revenue, again, also to minimize resistance. The government, of course, will not want a repeat of Gen Z's protests like it happened last year. So the government is also sensitive to such things. How you can imagine now the difficulty the CS Treasury will have trying to see how do we put this. If you put this provision, there might be a problem here and there. Also, let's appreciate that the government knows a lot more than you as an individual, me as an individual. For us, as a CPA practice, we'll know about ourselves, we'll know about our clients, the clients we are interacting with, and of course, the general news. But compare that with a government office or even a government office like Kenya Revenue Authority, which has access to millions of taxpayers' data. And it can be able to see trends and know which areas are more yielding than the other. And not just KRA. Remember, KRA is also interacting with the National Treasury. National Treasury is interacting with the National Bureau of Statistics. The data is available. So the government knows much more and can be able to tell, for example, online businesses are becoming more. Probably the brick and mortar offices are no longer, or places of business are not necessarily an indicator of how much a business is making. So there could be a business that is fully online, 100% online. It doesn't have a physical office anywhere, and it's making money. So you see those kind of things. The government is able to respond accordingly. So with that appreciation, then we have the finance bill, and this bill was tabled in Parliament. The dictates of when the finance bill should be tabled in Parliament is basically an issue of the Constitution and the laws of Kenya. So the CS Treasury nowadays is supposed to propose to the National Assembly. And the National Assembly is one part of the national parliament. Our parliament has two sides. It has the National Assembly, it has the Senate. And the National Assembly is basically more representative of the national government. The Senate is basically representatives of the county governments. So the idea is the government or the executive arm of the government proposes to the legislative arm, which is the national government, the National Assembly. And then the National Assembly will invite public participation, will invite different interest groups to provide their proposals and all that. So This happened on 29th April 2025. And of course, there are proposed changes. And those changes, the focus, our area of focus is basically taxes, and that's what we'll be focusing on. Of course, with the bill is initial proposals. So with the bill has proposed different changes. We propose to change this section of the Act, all that. Some of that will take effect on 1st of July 2025. So we are basically at the end of May. We are towards the end of May. So in a month's time or so, some of the changes will take effect. Also, there are some few changes that will take effect in January 2026. And then this is usually the trend. You'll find some changes taking effect at the beginning of the year of the financial year of the government. So that means the government starts collecting revenue based on the changes immediately the year starts. And then you'll find others, and especially the ones that touch on personal taxes. Then they take effect on the 1st of January. In this case, what will take effect on 1st of January are the changes in advanced pricing agreements for transfer pricing. We'll be discussing about that. And waivers of penalties and interest from errors caused by electronic tax systems. The government is trying to encourage issues of electronic transactions. And of course, we can all guess why. It's much more effective, it's much more easier, the government has more control. We are dealing with very many units in terms of individual taxpayers. There are millions. And besides the individual taxpayers, we are also dealing with companies, corporations, business entities. So one individual may be owning a number of them. So we are dealing with very many of them. So again, those are some of the changes that will take effect on 1st of January. So let's look at deeper. Let's dive in and look at the changes to the Income Tax Act. The Income Tax Act is it's good to mention it's a very old law of the country. It's very old. I think, if I'm not wrong, probably early 70s, early 1970s, or late 1960s. But it has been updated almost every year. I think every year there is a change, and therefore it's an updated piece of legislation. Although we can say it's old, because of the nature of income, then it's updated every now and then. And of course, as I mentioned at the beginning, you can guess why. It is because the business environment is changing, and the government would want to tax according to the businesses, according to employment, according to sources of incomes that different individuals and business entities are deriving. So it is the government trying to amend the laws as they happen, as things change. One of the changes that is proposed in the finance bill is the expanded definition. Expanded definition of royalty. Now, royalty is related to intellectual property. Intellectual property are things like patents, brands, trademarks. So if somebody is renting or is using intellectual property, that person pays royalties to somebody else. A very good example that I can give currently in Kenya, for example, is we all know Shell petrol stations, Shell. And Shell left Kenya some years back, but many people don't know that Shell as a company, I think it's an Agro-Dutch company, left Kenya. But the company that took over, which is called Vivo Energy, decided to retain the Shell brand in Kenya. And that's a business decision. Why? Because probably in the view of Vivo, then Shell would be a very good name. So my assumption is Vivo pays Shell, the international Shell, which is officially not in Kenya, but the brand is in Kenya. The brand is used in Kenya, and because of that, then the good name that Vivo wants to ride on is the name of Shell. So Vivo will pay royalties, and those royalties are aimed at, it's income basically to Shell, the international Shell, and of course expenditure to Vivo. And since it's a business decision, it's an issue of comparing whether the benefit you are deriving from royalty is worth it. And in the current business environment, one area that has a lot to do with royalties is software, because software, it takes time, it takes a lot of investment to build a very good computer software, a good application that can be able to do the different things that you'd want it to do. So because of that, there are companies that have invested globally, to make quality software. So if you want to use that software, then you subscribe to that, and you use the software. You pay the company that owns, but you may want to distribute, to give it to somebody else as a representative, as a business person. You get the software from the developers or the owners of the intellectual property, basically. Sorry, as an intellectual property, and then you give it to somebody to use. So here, it has been a serious a kind of uncertainty, if I may put it that way, in terms of whether distribution of software should attract royalties. If I get software from an American company and I give it to my customer, what am I doing? Am I just, and remember, this is not tangible. Software is not, it's not like a vehicle where I import a vehicle and it can be seen, it comes through a ship and it can, this is something that cannot be seen. So there was a case where KRA, or they say the commissioner was fighting with a company called 7Cs Technology, and it was highly publicized. And the court ruled that software was not part of what, there should not be any royalty. And because 7Cs is a technology company, the KRA had assessed 7Cs and had claimed that it ought to have withheld on royalties for distributing software. But of course, the court went on for quite some time, and it was decided by the court that KRA should not charge. So this case now or this time now, the finance bill is trying to seal that loophole so that distribution of software will be subject to withholding tax. And you can also see the trend here. I don't want to say it's ill motive on the part of the government. The government would want to get as much money as possible. So if distribution of software is not part of royalties, then, and the court has decided that's it, it's okay. The government decides that's okay. But now going forward, let's make it part of royalties. And that's how the government ends up with that change in the current finance bill. There could be companies that would be affected, especially if you are dealing with the distribution of software. You are using software that, and the software here can be, there could be very many types of software. Could be like, for example, on cybersecurity, there could be applications for different functionalities and all that. So you may want to look at it specifically whether your business has been affected if you are in that line of business. The other part that's a new change, expanded the definition of related person. Related persons here affects when you define a related person. In ordinary use, when we say a related person is a brother, sister, probably a spouse, daughter, son, and all that. But of course, you can look at the government trying to come up with transactions where there are family issues. And one area that is touched a lot is on transfer pricing and capital gains taxes in our current environment. So here the bill is trying to include relationships that are based on marriage, that is the issues of spouse and in-laws. That's what we call affinity. And kinship relationship by blood, where it's an uncle, depending on the kinship, the extended family, where you have father or the parent and the children and the brothers of the parents and the children and all that. So the definition is being expanded to as much as possible. And here now, when it comes to transfer pricing, is an issue of control. Transfer pricing is where an entity in Kenya, for example, it has related entities in other countries. So it is of interest how you relate with those other entities. So how you are controlling the Kenyan operation. You can control to an extent that you reduce or increase the tax that is due from the Kenyan entity. And transfer pricing has been a very interesting area of late, where you have companies doing business across different geographical, political jurisdictions. And we'll also be discussing part of that when it comes to those agreements I mentioned at the beginning. Again, capital gains taxes. If I'm selling something to my daughter or my son or my brother, how is it really a business transaction? Is it a an arm's length transaction. And here the interest is the price that I arrive at will not be like if I'm selling to a complete stranger. Again, also the government would not want to interfere with the family, family, intra-family, what I would call intra-family, inside the family matters. So it would want to be fair, so that in case I'm just transferring something to my son or my daughter, then it becomes it's not a business as such, and therefore the government should not treat it like a business. The other bit is on allowances. The changes. There are changes on allowances and pension per diem. Tax-free per diem increased from 2,000 to 10,000, which is quite a significant increase. And this is where you, or an entity, a business entity, will pay for, for overnight stay outside the area of work. And it's when somebody has been paid, or an employee has been paid to go and work in a different location. The distinction here is to ensure that this is not ordinary emolument. It's not ordinary, it's not an allowance, it's not additional income to that employee. So it should not be treated as income. It is just, for furtherance. The basic rule is furtherance of business. The entity is giving the employee to go to Kisumu from Nairobi, for example, and because one is in Kisumu, will need to spend, will need to a hotel somewhere to stay. That becomes an added expenditure to that person. But now to facilitate, the entity will give that per diem, or overnight, sometimes called overnight allowance. But per diem is generally used, is like saying per day allowance. Now, here it is a note that these are threshold. You can also have more than that if it is an actual expenditure that will have like what one would call a receipt. For example, I'm paying for a hotel in Kisumu, 20,000 for my staff. That's okay. I'm paying directly to the hotel. I'm not giving the employee. But if I'm giving the employee and the employee is accounting for it with genuine tax invoices, then again, there's no problem. Here we are talking of, this is an amount and it's for traveling, and it is an actual travel, and I'm sure the transactions can also be able to demonstrate that, then it is tax-free. Then the other bit is on change in gratuity and retirement allowance for public pension schemes. This is basically for government pension schemes. The public pension is where the definition of public pension is pension paid out of a consolidated fund. Consolidated fund is basically where we are putting all the taxes. And this mainly affects the people we call civil servants, not public servants, civil servants. The distinction here is that those who have worked with the government, it's those who work in the ministries, the line ministries, and the pension for those people, it is provided and mainly is non-contributory, what we call non-contributory pension. Because somebody is working, then part of the benefit of, or part of the reward for working in the mainstream government, and which traditionally has been cited as, is a general way that the salaries are low for the government civil servants. Whether they are low or not, probably that's not an issue for discussion now. But generally, the assumption was that as you work for the government, then there is a corresponding amount that accumulates as part of your pension. That's why we call it non-contributory. You are not contributing, but it's a benefit that is accruing somewhere based on some formulas. The longer you work for the government, the higher the amount in non-contributory part. But nowadays, all those things have changed. But basically, those are the people to benefit from this change, to ensure that whatever gratuity is paid or retirement allowances, they are tax-free for retirees, irrespective of the age or sector. It's basically trying to be sensitive to people who are retiring. Remember, when a pensioner is receiving a pension, when a retired person is receiving a pension, that is income to that person. And since that person had not contributed, it's not like he had put that money somewhere in a bank, then that person is getting income. But now, since these are our seniors, these are retirees, the government is trying to be kind of fair to them, so that they are not taxed. Now, another change is what is called significant economic presence tax, SEPT. Now, SEPT is a new tax, and a new tax aimed at those entities that are doing business in Kenya, but they are not residents in Kenya. These are entities which are doing online business. You can be able to, if you go to a website, you go to a portal somewhere. Just for example, the ones that are called the online giants like Facebook, Google, and all that. You can just pay, and the money is available to them, and they provide the platform to you, or whatever service they are providing to you through their platforms. So here, the government is introducing what is called a significant economic presence for business that is connected over the internet or any electronic network. And a non-resident person is considered to have a significant economic presence if the user is located in Kenya. That's what the income tax is trying to, the bill is trying to change the Income Tax Act to define what is significant economic presence. Significant economic presence is you are online and you are providing the service to somebody who is in Kenya. There was a minimum amount of 5 million turnover threshold, which kind of was trying to target only the big ones. Although 5 million is not such a big figure, I mean, if you consider an annual turnover amount, but that has been removed, meaning all businesses, regardless of turnover, will now be subject to significant economic presence tax. Now, note that we are not talking of all businesses in Kenya. We are talking of an entity that is carrying on business through the internet or any electronic network, maybe that would be for technology people to distinguish. But basically, the government wants to target those ones. And because of that, then there is a tax. I have not captured the specific amount. I think my team will help me to check on that. The specific rate of SEPT that is due for those that are qualifying. I remember, I don't know whether it was, I don't know whether it's the one that was moved to 1.5%, but my team, if you can kindly just check on that, it would be good, so that when I'm giving it, I'm giving the factual, the correct amount or the correct rate. The other change is the minimum top-up tax. This is basically for entities, again, multinationals, multinational enterprises, if they are doing business in Kenya, and the amount of tax they have paid is lower than 15%, the amount of tax, what is called an effective tax rate, is less than 15%. Then that multinational is expected to top up. And that top up is to arrive at that minimum of 15%. We have given an example here. If a multinational is operating in Kenya, and because of the way it's operating and because of the tax incentives that are available, it pays taxes, but ends up paying, say, 10% of its 10% of net taxable income. Then that amount of tax is deemed to be too low, and the government expects it to top up from 10%, add an additional 5% to make it 15%, and therefore meet that threshold of minimum. Note that this minimum, that means the multinational can even go beyond the 15% minimum. Now, there are quite a number of provisions here, and it even the bill even gives details of how the calculations should be done. Talks of covered taxes. So it is good also if, as a participant, your area is or your entity is affected by this, you may want to take time to go through the finance bill. We can also discuss after this, just to be sure that you are, you are very clear, and especially one very important thing for us to understand is that taxes are on individual entities. It's either a natural person or a legal entity. So a webinar like this will be giving you the general understanding, but when it comes to specific provisions, you'll find the law will try to include this, exclude that. So it's always good to ensure that when it comes to you now as an individual or the specific business entity, then you are aligned to the specific provisions, the details that go into calculating, for example, in this case, the minimum top-up tax, and how to go about it, including those calculations, ensuring that you pay the right amount, and therefore you are not penalized. The other change in the income tax is minimum tax cleanup. Here, there are, withholding tax is basically part of income tax. To know that. We also have withholding on VAT, but in our case here for this slide, we are talking about withholding income tax. And withholding income tax is basically one entity trading with another one. It has entity A has invoiced entity B. And then when entity B is paying A, it withholds part of what has been invoiced. And this one is quite a very good way for the government to get money. And it's not costly for the government because remember the government, people as they are trading, they are just able to withhold and remit to carry. So you'd expect, of course, the government would want to expand that as much as possible to ensure it gets as much as possible, and therefore it's expanding. Public entities and scrap sales. If you supply to an entity, a public entity, or if an public entity is being supplied to a public entity, in this case, we are dealing with the government entities, parastatals, and 1,001, types of public entities, hospitals that are owned by the government, schools that are owned by the government, ministries, parastatals, even county governments, they are public entities. Then here we are also, they are also introducing scrap sales. Scrap sales basically, like scrap metal. We are used to mainly talking of scrap metal. Scrap is basically what remains, like in a manufacturing setting, have scrap, part of what is not being used. And most of it is sold. Most of it is sold to other entities. Scrap metal has been a big business for many people, and it is the way scrap metal is collected is, very many, people are collecting and they are taking to an entity somewhere and they are being paid. So they'll be holding tax on that. And in our view, that's trying to formalize, is trying to discourage informal way of doing business. So if somebody is collecting scrap metal, for example, and giving to what are called steel mills, or these companies that melt those metals, and they come up with either metal ingots, or they come up with different things that they make from those metals. Then when they are paying those people, they ought to withhold. And of course, when it's withheld, it means you must be having a PIN, and because you have a PIN and it has been withheld, then ultimately the government or carry will expect an annual income tax return. And these are some of the, I would say, ingenious ways of the government trying to ensure that everybody is within the tax bracket. The other bit is on losses and corporate incentives, capital losses, provisions, now capped up to 5 years. When you have a loss, when you have a tax loss, that means you have carried out your business and there is no profit, it's a loss. Then the loss, of course, the government will not expect to receive tax for that year because it's a loss. But then you carry forward that loss. You carry forward because the expectation is that next year, if you make a profit next year, then whatever tax that was due to be paid next year should be reduced by the loss for, the tax loss for current year. I hope I've said that clearly. Just for clarity, we have this year, the entity has suffered a loss, and because of that loss, then no tax is due. But there is what we call a tax loss. A tax loss meaning a percentage. If, for example, we are using the rate of 30% of that tax law, of the loss, then that tax loss should be reduced, should reduce whatever is due in subsequent years. So depending on the number of years that you have suffered tax losses, is up to 5 years. You can only carry forward up to 5 years. Previously, there was no limit, and probably the government has seen some entities that are abusing that. And it's usually it's an issue of economics, because if you are carrying on business for 5 years and you've never gained any profit, then the government will have a question and ask you, how are you surviving? It's as much as you may want to say for sure it's a loss. Probably it is, yes. And this is where now I usually say it's an issue of your argument, the evidence you have to support your case. But if you have done it for continuously year 1, year 2, up to year 5, and there's completely no taxes that you paid because of tax loss, then and here we are talking of, it's good also to clarify, here we are talking of a capital loss. A capital loss is coming because we are reducing our taxable profits with what is called a capital allowance. And let me just to ensure that everybody, because I know not everybody is an accountant, it's good everybody to be on the same page. The fact that you have invested, you have put a lot of your money in a business, and you have, let's say, invested in machinery that you are doing manufacturing. The government would want to encourage that. And of course, for obvious reasons, you are going to employ people, you are going to pay taxes in the future because you are going to make money and all that. So the government gives what is called an investment allowance. An investment allowance is one way of trying to encourage you. And the investment allowance is because you have invested 1 billion shillings, then before the government asks for tax, then you reduce the taxable profit with the amount you have invested. That's what we mean by an investment allowance. So in this case, you can, because of the significant amount you may have invested at the beginning, you can have a capital loss. A capital loss meaning it's a loss, but it's becoming a loss because you have reduced the taxable profit with the amount you had invested initially. And there could be other forms of capital allowances, like wear and tear, what we call industrial building allowance. They are all capital allowances. They are provided in the second schedule of the Income Tax Act. And there is also besides the capping, the bill is proposing to eliminate the investment deduction that had previously been available for significant investments outside the Nairobi and Mombasa counties. The government many years ago came up with a policy of trying to encourage companies to invest outside the main towns, outside the big towns. Nairobi, of course, is the biggest, and as a way of trying to ensure investments are also distributed throughout the country, then the company that has invested in Nairobi County, outside the Nairobi County, would be more encouraged, and that's basically where the policy originated from. So, so that investment deduction, 100% means if you have invested the 10 billion, then you remove 10 billion from your profit, and therefore it reduces the tax burden on somebody who has invested outside the Nairobi. So that will mean that there is only the standard investment allowances, 10%. There are specific provisions. There are specific provisions which are set out, and maybe these details are not here. These are details that we can be able to guide you on, and they are available publicly also in the finance bill, in the Income Tax Act, where there are investment allowances which are standard. That means every county is now considered uniform with this finance bill, assuming the proposal says through. That bit of Nairobi and Mombasa being considered separately is being removed. So it goes now to those that depending on the investment, and of course the investment is dependent on how much you have invested and the asset type. The government would want to encourage, for example, manufacturers more and more, and you'll find those incentives. There are also those called special economic zones. Special economic zones is a recent addition to what used to be called export processing zones by the government. So, for many years, the traditional export processing zone they are the river-known one. There were others in Mombasa, Miritini, and of course others came up. Like I remember the Didalu factory that was making money was an export processing zone. There are Waraka export processing zones, but now there are special economic zones that have come up, and those special economic zones are supposed to encourage investments, whether from internal or external investors, and they are now distributed in many parts of the country. The government has been coming up with very many of them in special economic zones. And with each special economic zone, with the special economic zones, there are incentives that go to that. Not just tax incentives, even in terms of infrastructure, in terms of probably even very significantly, the fact that you are together in one zone, then the government is treating you in a particular way. And I'm sure you may have heard about the Naivasha coming up, special economic zone, Dongo Kundu, various other places. There are also private areas of investments, like Konza is a government one, but like Tatu City has been designated as special economic zone, and all the lands has been designated as special economic zones and all that. Capital gains tax exemptions. Capital gains tax exemptions. Transfer of property from an individual to a company is exempted now based on the proposal. Capital gains is a gain, is a tax on a gain, and a gain is where you are selling an asset. You bought it at this price, and an asset like land, a physical asset like land, for example, or or interest in a company, like a shareholding in a company. So transfer of property from one individual to a company where the individual is a sole shareholder. It's like transferring the property to yourself. Only that now legally it's a different entity. Then it means, if the proposal goes through, then it's exempted from capital gains. So it encourages the people to incorporate for personal assets, and probably good for planning purposes, structuring ownership of assets, probably in succession planning good. Nowadays, people do that. For example, instead of subdividing a piece of land, if you own 1 acre of land and you have 10 children, instead of subdividing it, then you transfer that land to a company, and then you give your children shares in the company that owns that piece of land. Those are things that are structured, and they are coming up nowadays, and they are good ways of trying to plan in a more practical way, rather than physically subdivide into economically and viable pieces of property. Advanced pricing agreements. This is, I had mentioned about transfer pricing. These are change, and there was an article sometimes back where I can't remember who wrote it, was praising this bit some weeks back about advanced pricing agreements. Just to make sure that the context is well understood, transfer pricing, I mentioned, is where one entity in Kenya is trading with another entity outside Kenya, and those two entities are related. They are related in that the exercise of control, or probably in terms of ownership, is the same. And it becomes interesting because how the two entities are trading can affect the Kenyan entity, and therefore the tax due to carry. For example, if you have a company that is owned by a company in, let's say, transferring goods from China to Kenya, and the Kenyan entity is importing from China, it is being sold to by the entity in China, and that entity in China owns the Kenyan entity. Of course, now it means that that entity in China will dictate the pricing. The entity in China can charge more to the Kenyan entity. That means the taxable profits in the Kenyan entity will be lower. And it can affect the revenue, it can also affect the expenses. If, for example, the Kenyan entity is paying management fees, it can pay a lot to the Chinese entity. And this is why the issue of ownership is important in transfer pricing. It is basically transferring the burden from one entity to the other. Why? Because the two entities are related. The one is exercising control over the other. So here, the government is coming up with advanced pricing agreements. Previously, there used to be transfer pricing policies, the government telling that entity that if you are dealing with your related entity outside Kenya and you are trading, we want to know how are you determining the pricing. So you come up with a transfer pricing policy and you say, we determine our prices based on these costs, we put this markup, and therefore we determine prices this way, so that the government can be able to tell, is it arm's length? Arm's length meaning, is it like if you are trading with any other unrelated business? So in this case now, the APA framework, or the advanced pricing framework, advanced pricing agreements framework, here you come up with the pricing in advance and you tell the government, and it is valid for 5 years. So in 5 years, the government can be able to predict how much you as a local entity is going to pay to the other entities outside Kenya, or the other entity that is controlling you outside Kenya. The commissioner has the right to cancel in an APA if there is misrepresentation. That means you are not sharing the whole truth, you are not giving the whole picture. And that issue of APA is is a very interesting area for a company, and it's a big topic which you may not know about. And so is the same about country by country reporting for multinationals. If an entity is reporting, is doing business different countries, it's supposed to report for each country. So there is a new provision that has been put in where the government requires you to designate the parent, or what we call a surrogate parent, for reporting purposes. And the technicalities of this is basically to ensure the government is deriving much more from the multinational. And the multinational is not able to shift from one to the other based on what is convenient to it. It has appointed, if, for example, if you think about a multinational that is headquartered in London, that it has presence in every other entity, every other country. So it can be able to shift from, and say, Kenya deal with the Ugandan entity this time in terms of pricing, or but as far as the Kenyan entity is concerned, then the government would want to know how are you determining that. It's not at your convenience, then it becomes more for the convenience of the government. In terms of time, I'll try to hurry up just because to ensure that we save on timing. The other changes, change is on mortgage interest, where the government has expanded construction costs. That means there is relief now, besides relief on mortgage relief, where you have bought a house, then if you are borrowed to do construction for your own purposes, then you will get mortgage relief. That is a good thing. The government is also removing the acceptability of deduction, or when you give money, when you donate money to a sports sponsorship, then that money is not an allowable expense for purposes of determining the taxable income. The government instead wants you to sponsor public sports facilities. And of course, you can think about why probably the government wants you to do much more to build, because many entities will sponsor sports just out of publicity as part of advertising. But in the real effect, the effect is minimal. It's not substantial. It has no long-term effect. Digital tax asset. These are taxes that target the financial technology companies, those dealing with the cryptocurrency, for example, dealing with those new technologies that have come up. So digital tax asset has been reduced from 3% to 1.5%. We can say this is good because it's encouraging the modern economy. The part on VAT, there are changes to the VAT Act. We all know about iTax and eTIMS, which has become very important, and especially nowadays that we have something called the table, I can't remember, the blacklisting table that is creating problems for many entities. So tax invoice now defined to include the electronic tax invoice, the same way as the Tax Procedure Act. That means it is now much more solid. It's in the VAT Act 2013. Previously, it was under the Tax Procedures Act. And of course, this is expected to be in eTIMS compliant. So if this is basically for purposes of ensuring standardization of invoicing. When you are putting in a VAT that you'll be charged VAT, then it is expected to be guided by this provision in the VAT Act, which is trying to match what is already provided in the Tax Procedures Act. Utilization of credits, VAT withholding credits. VAT withholding, when you invoice plus VAT, of course, part of it can be held by somebody who is designated as a VAT withholding agent. And currently, the VAT Act allows for VAT registered persons, you either apply for a refund or you automatically offset for the amounts payable in the subsequent periods. So the bill is proposing to repeal this. And you're only going to be permitted to claim refunds for excess input, only. Here is an issue of if maybe I can just explain it just for clarity. Because you have input VAT, that means if VAT that you've been charged and you have the option of claiming either to be refunded, that means you get a specific amount refunded directly from KRA, or you have the option of taking it to the subsequent month. That means you roll it to because a credit, you can deduct it in the next. But now the bill is telling you it permits the taxpayers to claim refunds for excess input VAT. That means you are just to put it across. You are not expected to claim refund. So it will be basically aiming at to reduce those who are applying to be refunded, and therefore it is more of you claiming it as an input in subsequent in subsequent months, in subsequent when you are making the next the next returns in the next month. And the VAT refunds are, I mean, have been touched quite a lot in the current finance bill. If you have bad debts, for example, bad debts meaning you invoiced and you have not been paid, you have not been paid by your customers, but you had a VAT element in those invoices. So previously, there was a requirement that it can only be a bad debt if it has stayed for 3 years. But now it has gone down to 2 years. That's good. It means it is encouraging more efficiency. There is also offset flexibility, referred VAT on once you get approval from the commissioner, you can offset VAT liabilities for when you have VAT bad debts refunded. That means you make an application and the commissioner accepts the refund. And because of that, then instead of you getting the money directly, then you can tell the commissioner, please offset my debt that I have on VAT. Zero-rated and withheld VAT refunds application period again reduced from 24 months to 12 months. That's better. It means the efficiency level is expected to be higher, and therefore, in terms of KRA processing the refunds, probably avail more cash flow to traders who are forever claiming refunds. It's mandatory to issue tax invoices. So currently, a VAT registered person is only required to issue a tax invoice to a for a taxable supply, but now it is applying to all supplies. It's applying to all supplies. Why? Because the taxman would want to know who are you supplying to. It's not just about those who are, the goods you are selling that are taxable, but all the items you are selling. So it kind of touches on the income tax side, because it means if you are selling the total of whatever you have sold, the total turnover, you have interest to the taxman, not just the VAT sales. And of course, the eTIMS compliance, again, transparency, and helps to KRA to reduce on whatever changes. Exempt goods, some things have been changed from exempt to VAT. Food supplements, medicaments, aircraft parts, quite a list, quite a number of things. Others moved from zero-rated to exempt. Zero-rated is usually by practice better than exempt. Why? Because with zero-rated, you are allowed to have input VAT. It reduces whatever VAT you have incurred in in relation to that item. You can be able to reduce. But what has been moved from zero-rated to exempt: farm animal foods, local mobile phones, motorcycles, electronic vehicles. So there have been increased costs in those items. By implication, projects also, the projects that are aid funded, issues like fuel, tires, lubricants, they are currently exempt, but now they be charged VAT. And probably this is, in terms of administration, is very difficult to monitor that. Maybe KRA has found it easier. The final part is on excise. And excise is basically charged on items that are manufactured locally, and it's usually associated with what are called, day-to-day use, and mainly luxurious items, non-essentials. But of course, it has extended. It's also debatable what is essential, what is not, like mobile calls or text messages nowadays is considered essential. So the key changes, again, there'll be here the digital lenders have been, by definition, excludes banks, SACCOs, and microfinance institutions. So only for digital lenders, there'll be excise. And it's excise on fees, not on loan interest. And good to know that digital lenders are those who are exclusively in the online platforms. They are not the SACCOs that have, mobile phone platforms or MFIs or banks that have online platforms. It's for those who are digitally in lending. They don't take deposits. They are just doing their business of lending, use their own money or private. Changes, other changes, non-residents offering services to Kenya and online will pay excise duty online. That means those who are paying the non-residents will be expected to facilitate that. KRA must approve, reject excise licenses within 14 days. So a KRA will be expected to do faster processing. And then new tax rates, alcohol, which is undenatured extra neutral alcohol. There's an extra tax now put in. Probably those who take alcohol, this would reflect in the pricing, 500 shillings per liter. And then excise duty has been removed on imported eggs, onions. Excise duty, in addition to local manufactured goods, also sometimes is applied on imports. And you find, like, for example, motor vehicles, there is excise duty, electronics, excise duty, such things. Changes in the Tax Procedure Act. The Tax Procedure Act was introduced in 2015, and it is basically for purposes of procedure. It is like governing the procedures of how to deal with the taxman, how to administer taxes, in terms of registration, filing, refunds. So the bill providing those rules and is trying to enhance clarity, ensure efficiency, transparency. Of course, calls for transparency. You can associate them with the current kind of awareness, level of awareness, even freedom that were introduced in our constitution. So there'll be proposed changes. The commissioner, when they are making an assessment, will be expected to come up with very clear justification of an amended tax assessment. So it's not just, it's an issue of fairness. There ought to be justification. Penalty relief for withholding tax. If one party has not withheld in a withholding tax transaction, but the party that was paid, if the party that was paid actually paid the taxes, then there'll be no issue of penalty. In other words, A paying B, A did not withhold, but instead B paid directly the amount that ought to have been withheld by A. So that kind of introduces more fairness. Timelines for objections and appeals, public holidays and weekends will now be counted. Meaning if it's 90 days, 90 days includes weekends and public holidays. If it's 30 days, the same. So we just take the calendar days as they are. We don't start talking of working days. Of course, you'll appreciate that with technology nowadays, issues of whether it's a working day or not is becoming a bit blurred with time, because there are those who work at night, there are those who work on Sundays, and all that. Key proposed changes again: late objections. You're expected to respond within 60 days from the date of acceptance. If you're objecting, that's in the Tax Procedures Act. Refunds, offsets, and penalty reforms. Refund processing extended from 90 days to 120. That means giving more time to the taxman to process refunds. And in case the taxman thinks of auditing you, the taxman can have up to 180 days. That's basically just about half a year. So in case the taxman is auditing you, and of course you can think why, because the taxman would want to confirm before giving back what you are claiming. System enhancements, again, data access, eTIMS exemptions. What is exempted from eTIMS? Emoluments, that is payments based on the salaries, allowances and such things, imports, payments. And then investment allowance transactions will be excluded. That's basically just to provide more clarity. The commissioner has also been given more powers for data access. Issues of privacy, I've seen some in the media, people complaining about this, that the taxman is being given more powers, and probably you can expect this will continue more and more, because information is more online, is more cyber related, is less of paperwork. So the taxman would want more access to information so that they can be able to make their decisions. Waiver of penalties. Cabinet Secretary may waive penalties relating to malfunctions of systems. Like if eTIMS is not working and you're filing a return, is a deadline, and if you don't file today, tomorrow you'll be penalized, then the CS, the Treasury, has the power to waive. It has been long. I probably have taken longer than necessary, or probably longer than expected. Not necessary, probably it was necessary because I had to bring out all that is very key for those changes and try to explain it as clearly as possible. Good, we understand that we are in a digital environment, and we need to be compliant. Compliance with the laws. Remember, taxes are dictated by laws, and it's not just in Kenya. This is happening globally. Governments are under pressure to deliver more to the public, and the public may not want to pay much. Increased awareness means people are more informed, they are more questioning, they can raise concerns, they can even mobilize and go to the streets like happened last year. So the government is a bit more careful. So let's prepare for those changes that will take effect from July. If an area has been touched by those proposed changes, think about them and think about seeking clarity or guidance where necessary to ensure that you are well covered and you can be able to really distinguish whether you need to take action on your side or not. Don't rely on social media, don't rely on the general media, newspapers, because you need to know specifically relating to your business, relating to your entity. Whether you're an accountant or you are the business owner, you need to know specifically related to your business. If you are doing manufacturing, it's not the same as somebody who is doing importation of vehicles or doing online business. So every business will have its own effect. And ensure that you document. my principle is that the first step in tax planning, the first step is to document all your transactions. Make sure you maintain proper books of accounts. Make sure you put your house in order. It's not easy to do that in practice, but of course, it becomes more and more critical as the government becomes more and more aggressive in terms of raising taxes. So we need to ensure that we know what touches us, what specifically can ruin our businesses or can be damaging to our businesses, and take action before it's a crisis. The crisis comes when KRA is knocking at your door and asking for documents that you cannot trace. So we highly encourage, as a firm, we highly encourage our clients and basically everybody to be compliant. The issue of whether the taxes are being used fairly or not can be addressed in a different forum, because you don't want to be the ones in problems and you are being shown like an example to others. And of course, you can engage in public participation and question whatever may not be good. You can even demonstrate, of course, peacefully, if you are not happy with something. And it's good, it's part of our rights as a country. We are fortunate to be in a country that allows for all those rights. I know it has been long, it has been quite a lot. So at this point, I will take it back to our host, Frida, and request that take up. I don't know whether there are any questions in the chat box, comments that we can address, matters of concern or comments that can be raised also through people voicing them. So Frida, please take up. Thank you.
All right. Thank you so much, Dan, for that detailed analysis. It was very insightful and informative, very relevant to our SMEs that we have in our today's discussion. My key take homes were many, especially on the area of the withholding tax for scrap metal business owners and the issue of VAT refund. And also an interesting topic for many of us as Kenyans, especially for retirees, the fact that they will not be taxed on their pensions. That drew me to its attention, and the issue of DMs. It's good to note that from this discussion, we have gotten to understand that the government comes with the finance bills every other year. The key aim is not to harass us as Kenyans, but we want to raise revenue to finance the budget of the year. So it's good for us as SME owners to stay compliant and ensure that we pay the relevant taxes that apply to us as SMEs. At this juncture, I would like to welcome you all. If you have any question or an area you felt that was not addressed, feel free to unmute and raise your question, or you can use the chat box and type your question. We have a team of experts who will help address these questions. I would also like to welcome John to clarify on the SEPT issue that was raised by Dan. Yeah, and also I have a question for Mr. Samuel, if he's still around. Do you feel that your question or your key point has been addressed? Like, have you understood how the finance bill affects you as a common mwananchi, or you would like further clarification on the same? Thank you so much for joining us and taking time to attend our webinar for today. It was a pleasure having you. So welcome, John. And then to the rest of the attendees, please type your questions on the chat box area. And if you feel free, if you would like to raise the question, raise your hand and then we can allow you to unmute and speak. Yes, thank you so much.
Thank you, Frida. The question that I think it was just a clarification on the tax rate for the significant economic presence tax. And I had already posted the clarification in the chat box. But precisely, the rate is what is taxed is the 10% of the gross turnover of these non-resident entities that provide digital services to users in Kenya. So the 10% of the gross now is taxed at 30%. So that gives us an effective rate of 3%. I hope that is clear.
Thank you, John, for that clarification. I would like to welcome Beatrice, maybe to give a comment on maybe someone who has not taken time to go through the finance bill. They are not a common, they're not business owners, but they want to know how the finance bill, the proposed changes are likely to affect them as ordinary Kenyans. Welcome, Beatrice.
Thank you, Frida. From this discussion, my urge is for our audience to be on the lookout on the changes that will take effect, most likely at the beginning of July, just to ensure that they are compliant in terms of the taxes, and also to ensure that they do not get into a mix of paying penalties and interest to carry. Thank you.
Thank you so much, Beatrice, for that comment. I can see we don't have any hands raised. All right, I can't see any hand raised or any comment in the chat box area. But it's good to note that at John Daniel and Partners, we are committed to supporting you through your journey as a business owner and are available to provide personalized advice and strategies tailored to your business needs. Feel free to reach us through the provided email address, that is info@johndaniel.co.ke, or you can call us at 0722-817-818. And also, if you are around Nairobi CBD, feel free to pay us a visit. We are based at Nana Cows. Nana Cows is in Kimathi Street, opposite Nation Center, Nairobi. Yeah, so feel free to visit our offices, pay us a visit, and you can see one of our tax consultants. We are here to help you stay compliant and avoid any penalties from the taxman. At this point, I'd like to welcome John to inform you of our upcoming activity. We are intending to have a masterclass happening from 9th to 13th June 2025. John, please welcome and give more details on the same. John, I think you're muted. Please unmute.
Oh, sorry. You can hear me now?
Yes.
Great. Sorry for that oversight. I'm John. I greet you all. And mine is just to welcome you all to our tax masterclass that is scheduled to take place from 9th through 13th of next month. And this masterclass was informed by feedback that we get from the webinars that we hold. A lot of people requested or suggested to be taken through into details of taxation in Kenya. So we thought it wise to just curate some good content that covers the major tax obligations in Kenya and the practical side of it, especially when it comes to filing the returns in the KRA's iTax platform. And I think the best thing is we have hugely discounted the fee or the charges to just 5,000. And the masterclass is supposed to take 5 days, so it's just like 1,000 per day. And if somebody is able to pay before the month ends, then they'll be able to take an advantage of paying only 3,000 for the 5 days. So we believe this is a very fair fee, considering the content, the deep content that we will cover. Right from what we have just discussed, we will also cover any changes or any developments that will have followed the public participation that is being conducted with regards to the finance bill that we just discussed. So I welcome you all. The payment details are contained on the face of this poster. I think Frida will share with us. And I look forward to having you all, even as we learn and enhance our understanding of the tax and tax obligations in Kenya. I thank you.
Thank you so much, John. At this point, I'd like to appreciate you all. Thank you for taking time to join our session, and hoping that you found it relevant for your businesses. And we will share this presentation in your email. Thank you so much. Feel free to leave. And good day.
This is brought to you by John Daniel Partners LLP.